recent slide in the marketplace, many investors think there may be some bargains lurking around Wall Street. But what signs should you look for before getting back into the market? For some advice in today's online finance segment, I sat down with David Edwards of Heron Capital Management, also a columnist for TheStreet.com. So David, you're saying before anyone just jumps back into the market, there's 10 things that they need to take a look at before they do so. Obviously, we can't cover all of them, but let's try to get on the major ones. Obviously, earnings.
Right. The stock market is basically built on the back of good earnings. And the stock market was killed from, let's say, March 2000 to 6 months, the last couple of months, as earnings fell precipitously. There were 5 straight quarters in a row where earnings were negative. Quarter 2, up 1.3%. Quarter 3, we'll get the report starting in 2 weeks. Consensus is up 6 to 8%. That's a pretty conservative estimate after shaking out analyst bias to optimism. Fourth quarter, teens. Next year, teens. You factor that in with the market down as sharply as it is, interest rates as low as they are, that puts the S&P 500 down about 30% from fair value.
And we're talking about when the economic situation is as weak as it is right now, there seems to be more emphasis put on earnings overall. Is that true?
Earnings count an awful lot, and we've seen, obviously, with the corporate scandals that there was some low-quality earnings coming out. I think what you're seeing right now with the people getting handcuffed around the corner here is that earnings quality will be much higher in the years to come. But what that means right now is that companies are charging off as much as they can. And
they only have an option but to get better at some point.
If you're a CEO and you see your buddy from the golf club in handcuffs, that is a powerful incentive to lowball the earnings now so that you can do better in future years.
All right, let's move on and talk about the volatility index. You're saying as that goes lower, right, that's a good indicator.
There's 2 technical indicators, the VIX and the VIX-N. They're on all the major quote services. The first tracks the volatility of the S&P 100. The second tracks the volatility of the NASDAQ 100. Those are at or near record levels, just a little bit lower than last September 11. That is a fear index. The high VIX means people are very scared. And it makes sense. When you see your portfolio go up or down 6% per week, in a world where we think 6% per year is not a bad return, it's very unsettling. Until the volatility comes down, most investors will stay away.
All right, and the other one I want to definitely take a look at is the equity fund money. When that flow turns positive, what does that tell us?
Right, there's a company called AMG Data Services. Information is on the web, which tracks how much money is coming into U.S. equity, mutual funds, bond funds, international funds, etc. July had a net outflow of $40 billion. That was a record outflow. People liquidating their life savings at fire sale prices for no good reasons. August was down somewhat. September probably will be lower also. Until those equity fund flows turn positive, mutual fund managers have to keep high cash levels on hand to meet redemptions. They can't go back into the stock market.
Oh, wow. That actually does give you a good idea. You know, the other one I want to talk about here is that you have listed in here is the fact that indexes, when they open lower and close higher. What does that tell us?
When indexes open lower and close higher, it's bullish. When indexes open higher and close lower, it's bearish. This year, New York Stock Exchange volume is running about 80% of what it was during the peak stock market years. Absence of buyers lets hedge funds drift the market higher in the morning, short it, and close out in the afternoon. When you see the market opening higher and closing lower, it's hedge funds shoving the market down. When you see the market opening lower and closing higher, it's true buyers coming in and taking positions.
And that means people are actually having confidence in the overall marketplace. David Edwards, thank you so much.
Thank you.
Right after this break, a check on the business travel forecast. Plus, we'll head up to the big board for today's Outlook on Wall Street. Stay with us.